Right, hi. So this is assessment two. We're just looking at these, of course, task by task. And this is task one. And this is really a non-current asset register that we're working on. And here is the information. You have a scenario where this organization, yes, will part exchange an item of machinery, but we're not actually doing any work on part exchanges. They just are telling us the medium and the way in which this um, asset has been purchased. Okay, so here is the asset, the new asset, or one of the new assets that's been purchased, a screen printer. And I think it's identifying that you have the printer here, you have a floor stand, and both of these have been purchased for the long term. So here are the non-current assets, right? So here are the non-current assets. And this printing mesh, you can see it's a roll, there's 5 of them, will be considered revenue expenditure. So I'll just make very quickly um, sort of a point of this, really. So when you see this kind of thing, what they're really asking or trying to prove or get you to think about is that these two are capex or capital expenditure, and this is revenue, and this is revenue expenditure. So technically, if you're buying these, you would have this as a revenue expense, if you like, screen printing mesh of 626, and here you would have the printer 4950 and the floor 596. So here are the actual. So these are assets here. Yeah. So because they're assets, this is what will undergo depreciation. Now, of course, the credit side to this, of course, will all be dependent on how you're paying for it. So imagine you're paying out of the bank. The total will go out of there. Now, be very careful. What's interesting about this as well is that there is VAT. You're paying, so you will pay. This is what you're going to pay, of course, in total for all of this. But you can claim the VAT back. So because you can claim the VAT back, it is, if you like, currently, until you claim it back, uh, a receivable, an asset, and that's an asset of 1, 2, 3, 4. So these are all the debits, and the complete credit is the total of 7406.40, right? If you were paying this out of the bank, if you like, if this is what was being tested. But the point here is about these being capital assets, and it's about these being capital assets. Where are they? Where's my pen? My pen has disappeared. Yeah, about these being capital assets. That's the point here. Right. Um, we do know, we're told that what's happening here is that these have been acquired via a hire purchase agreement. So there is a loan. I mean, in effect, it is a loan. If you like, you have a loan here of 5306.40, and the balance, if you like, is via part exchange with the printer, which we'll come to. So we need to literally, I mean, again, if you think about it, a printer is an asset. I mean, it's almost a conceptual idea. Just like bank is an asset, you're paying with another asset. So imagine that's just the way we have bank, and you have money in the bank, and you credit out of the bank. You're crediting out of the old printer. You're basically crediting out of the printer to pay for this. Yes, for this new machine. So you're taking out a loan, and you're also paying using your printer. So that's why these two on the credit side, right? Okay, right. That's the point there. So let's come back here. So that you have all of that, and then the question goes on to tell you that here is the printer in question, and they just want us to explain how we actually delist or derecognize this printer. And you have some policies taking place here of depreciation. So you should be happy with this. So let's start with the top here. That's the plant and machinery, the printer that you've had, and you can sort of work that out, that you've had it for 2 years, and you can see that they're applying straight line depreciation, as you're told over here, over 8 years, right? And the question does tell you that a full year of depreciation is applied in the year of acquisition and none in the year of disposal. So whenever you buy it, charge a full year, but in the year of disposal, which is in this year, there is nothing, right? Nothing. And then you receive, or we record 1750 in printer, of course, and the rest, of course, is VAT, because we can claim that, that VAT is not ours, in effect. Whatever happens with that VAT, whatever you receive for that VAT, in effect, is going back to HMRC. So it's not yours to claim as disposal proceeds. And that's the date over there. Here we are recognizing the printer and the stand. Here is the printer and the stand. Add those two things together, and just fill those in if you like, and then depreciate. Straight line over 8 years. So divide the 5546 by 8, you will get 693, right? And then you have that. And I think also it's important, again, 5546. So let's just sort of do this. I will just create a new let me just create a new, no, I don't really need a new snip, actually. I just wanted a new page. So I'll just go to just to explain again, because that's important for your thinking about this. Yes. So you have a scenario here where you are depreciating, and I think that's always important to understand the process here. You have an asset, 5546, that's your asset. And what you really have here is accumulated depreciation. So at the end of the first year, and here you have depreciation. So the depreciation expense, of course, is what we're dividing by 8. So 5546 divided by 8 is 693.25. So your first year is 693.25. Debit depreciation as in the expense of depreciation, and credit the accumulated depreciation, 693.25. And that's the accumulated depreciation. That's the first thing, right? Of course, this will go to the income statement because it's an expense, and that's the accumulated depreciation. So this gets carried down. Really, these two accounts are related, right? They are. I could technically have put this 693 in here and then done a carry down, technically, into the difference, right? But I do this, I keep them separate, which means that at the end of the second year, you're doing exactly the same thing, but you have a brought down figure already, don't you? So at the end of this first year, you would then do 693.25. You would then do this, brought down 693.25, right? You have 693.25 here, 693.25 here. So you have an opening balance of 693.25, which means at the end of the second year, when we do a depreciation expense again, 693.25, you will now have also 693.25. And this, which is why the value of this asset after 2 years would be the cost less 2 years of accumulated depreciation. Okay, great. I just thought I'd point that out as well. Discard. Let's go back to the question. And that's why you have, of course, a 693.25. In your motor vehicles, you are told that you're using what's referred to as a diminishing balance return. And you can imagine when it says carrying amount, this is the closing amount of this after 2 years. So you have 9440.64 and you have 531.5310. Yes. Let's just look at that again. 9440. 9440. This is the accumulated depreciation. This is the motor vehicle. Let's just find that again. Sorry. And you have 531.5310. 5310, right? So this is your opening position, right? Your opening position. So what we want to know and understand clearly is the carrying amount, or the, sorry, it's not the accumulated depreciation. Let me just discard that and just read that again. So this is the carrying amount, forgive me, at the end of the year. So these two charges together, I think it's important to reconcile the two so you clearly see what's going on. 2360 plus 1770 is the accumulated depreciation. If we were preparing this double entry, it's important to, in fact, I think what I might do then is snippet this out so that you can relate your double entry. Maybe I think that's what confuses students sometimes, relating the double entry to the non-current asset register. And then you have this. Right? Let's be clear. So what we actually have here in completeness, for completeness, is really this. This is what we have. We have cost 9440.64, and what we truly have here is the accumulated depreciation of these two things, 2360 and 1770, over 2 years, right? So this together, of course, gives you an accumulated depreciation 2360 plus 1770 is 4130. You're not going to see this in the non-current asset register, but I know that the difference between this and this is this carrying amount here of 5310. So you always have to do that first. And now that you have the 5310, you then multiply this by 25% to find out what the new depreciation charge would be, right? You can see here, this is a reducing balance method. You can see that the depreciation is falling. So because it's a machine, we're using it quite a lot at the early stages of its life, and that is falling in value as we carry on going. So by the time we get here, we now have 25% of 5310, which is why you have the 1327. So really what the double entry is depreciation, 1327.59 or whatever, 1327, and then again you now subtract the 2, which is why you will have a carrying amount of 3982. And that's the thinking behind this, right? So you're comfortable with the process, and you're not just you need to understand how they're arriving at those figures, because we are constantly comparing the cost with the accumulated depreciation. Okay, great. And we're literally doing the same thing for the last one. You have 678, sorry, here's the carrying amount at the end of the first year, and that's the cost. So you have the 8720 minus the 6540. Oh, sorry, that's the 8720 minus the 2180, giving you a carrying amount of that. Take the 25% of this figure, right? And 8720 sort of 8, we can just sort of repeat that again. 8720, 8740. Let's just check. 8720, correct. And 2180. That's the accumulated depreciation so far. That's the cost. So the net book value, of course, at the end of the first year is the 6540. And then, of course, multiply 20% of that, and you have 1635. Yes, 1635. So your double entry really is depreciation expense, which you do not see on the non-current asset. You don't see this on the current asset register. This is what you see, the 1635. That's sort of what you're seeing. So it's important to always see what's the other side. This is in the income statement, isn't it? And so you have your new carrying amount, of course, is this minus all of this, and that's what you're seeing right here, 4905. Okay, great stuff. And then it says here, what is the expected market value? I'm sorry, the residual value is really what can we sell this thing for? Scrap, so to speak, at the end of its life. And that's the first one. Cool, great stuff. Hope that helps for question 1.